Good morning, everybody, and welcome to our webinar this morning. My name is Kevin Uphill, and I'm the chairman of Avondale Corporate. And we'll be doing a webinar today for about an hour on how to sell your business to your team. I'm going to be joined today by Vincent and Sue Lawrence. Greg is a senior lawyer for Morrisons Solicitors and one of the key legal experts in employee ownership trusts. He does a lot of work with us on that side. And Sue Lawrence works for independent directors and trustees, and she's going to be talking a little bit about what it's like as a trustee running employee ownership trusts. I hope you can all see me because I can't. My screen is mucking around again as ever, but I do love a bit of Zoom. It never quite works the same way each time. But today we're going to be running for the first half an hour talking about the technicalities of employee ownership trust versus management buyouts in particular. So how to sell your business to your team? Well, of course, you've got those two options. We will, of course, examine why you might look at those two versus trade sales. For those of you who don't know Avondale, we help people buy and sell companies, management buyouts, employee ownership trusts. We also do a bit of strategy work and some fundraising, but the majority is transactional. And we've been doing employee ownership trust now for a couple of years, since 2014, when the Conservative Lib Dem government put in place the 0% tax. It has become a more attractive option than management buyouts. But we think perhaps less understood, and hence the event today to help you all understand it a bit more. So say half an hour where we're going to examine technicalities, and we'll be talking about that. And then at the end of that, another half an hour where really it's an open chat, open forum. Please address questions to the Q&A, and please add your comments and conversations as we go. Okay, so as I say, we'll be joined by Greg and Sue later. I'm the chairman of Avondale Corporate, and we've been doing employee ownership trust for 2 or 3 years now, and we need to examine how they fit versus the management buyout. Why have we started doing them? Well, fundamentally, trade sales, which is where we started, don't suit everybody. Trade sales work really well if you've got good recurring revenue, and you can create that we want, we need motivation in strategic buyers, because they will pay a higher price in that equation, particularly if they've got synergies and economies of scale. But not every business has that curb appeal, if you like, and sometimes therefore multiples can be soft. Often, for example, revenue is not recurring, it's quite lumpy, and those deals don't always suit trade buyers. And that's traditionally where the sort of management buyout is an alternative exit strategy. But of course, the difficulty with management buyout is you've got to have a management team that are willing to do it. And increasingly, you've got to have a management team that are willing to put their houses on the line, put personal guarantees in, go do the third-party fundraising, and all of that. So not everybody is right in terms of a management buyout. And you may not yet have a strong enough management team to sell the business to them. And that's actually where employee ownership really kicks in as a plus. The point about employee ownership is it can be a soft exit strategy that is a slow sale. You, as a shareholders, can continue to be employees so long as you no longer control the business, and therefore you've got time to build your succession and your strategy around that succession. Whereas a management buyout, you've got to have that team in place from day one. So as well as the 0% tax, there's a real benefit there to employee ownership trust. Of course, the other viewpoint, why is there 0% tax? Fundamentally, it's because governments believe employee ownership will help in terms of productivity. Employee-owned businesses are through surveys, proven to be more productive because people take more ownership in them. But I think the other point is they have better retention because staff have the potential for tax-free bonuses within that. So more on that later. I think they also, for long term, will reinvest more, and we'll examine that. So apologies for the detail on this slide. We thought that it would be really helpful to put all the exit strategies out. Now, we're going to be sharing this webinar. We'll be recording the webinar, so if you want to share it with colleagues, please do. And we also have this available as a PDF. I know that for the more visual of you, I've already lost you because you're now reading all the detail of all of these comments rather than listening to me. And that's kind of fine because it is the key slide of the webinar today. Fundamentally, we're going to be concentrating on the left-hand side. That is the employee ownership and management buyout, not on the right-hand side, which are also transactions we're doing. Partial sale to private equity. We're doing a lot of those at the moment. There's a lot of private equity money. And then, of course, the far side is the trade sale. But we're trying to put all four against each other to help you and your clients with, well, what exit strategy might work for you. So today, concentrating on the left-hand side, employee ownership versus management buyout. And, of course, the first area is valuation. So we've already said that, you know, trade deals and possibly private equity probably will be at higher values, but not always. If your business does not have strong recurring revenue, they may not be good options for you. You've got to have that we need motivation in those parties. Also with private equity, unless you've got $500,000 plus EBITDA, you're not in the room. And really often it's $1 million plus. So, you know, it suits bigger companies. Employee ownership trust kicks in with companies really around £1 million plus, minimum 7 plus employees. So valuation can be competitive. Most of the structures we're doing are over quite a long period of time. So where employee ownership trust wins against management buyouts is typically both are often vendor-led. So we should call the management buyout bimbos, actually, vendor-initiated management buyouts, because usually they are. Now, when you do a management buyout, your management team are looking to try and get the price down at that point because they're personally guaranteeing it, probably having to put some hurt money in to persuade the lenders, and consequently, you know, they are looking at driving the price down at the point of a deal. And typically, they will also look to, as with any staff-led deal, there'll be some sort of structure over time. Deferred payments, vendor loans is typical. So management buyouts tend to be on a shorter period of time than employee ownership trusts. And most of the employee ownership trusts we're running at 5 to 7 years. Some are even longer. And that, of course, enables you to get the value up because you can have a longer period of loan note against the cash flow on the business. So we're structuring most, well, MBOs or employee ownership trusts is what's the distributable reserves in the company? Can we get third-party debt? Do we want it? Or are we happy with just vendor loan? And also then what's the period? And in a way that dictates the valuation because you circle back to what can the business afford. Although with a management buyout, you've got the challenge that your management at that time are looking to get the price down because from their point of view, they're personally guaranteeing the payments and maybe also putting hurt money in to pay the transaction. So you have that tension point in terms of value. In terms of time scale, EOTs are slightly faster than management buyouts, and that's normally because management buyouts would tend to have a bit more cash up front, usually because they have some third-party debt. But of course, that third-party debt comes with more detailed due diligence, whereas an employee ownership trust, the due diligence is much lighter. I have to say, when we're running employee ownership trusts, we do detailed due diligence for the trustees. We believe that's absolutely critical because there's a sort of a strange scenario. When you do an employee ownership trust, you're selling the business to a trust for the benefit of the staff. But you've got to feel happy that it can afford to make the payments. So in a way, the company's almost buying itself and you're almost selling the business to itself. So there's a responsibility to do a very detailed valuation, and the way we're doing it is in effect a form of mini due diligence, but less fussy in terms of warranties and issues within the business, so long as the cash flow's there. Whereas again, managers, third-party debt, quite rightly more fussy, will want more warranties and are more risk averse. So process is a little different there. The other element of process, in both cases, you would go for clearance to lock your tax breaks in. We've got entrepreneurs relief at the moment. It's under threat, as you know. First million per executive shareholder, 10%, thereafter 20%. That went up last March. Employee ownership trust, capital gains tax is 0%. And the 0% is because the government are trying to encourage these transactions because they believe that they're more productive. I'm actually very positive about the employee ownership business model because I think it's part of purposeful capitalism. And I think the government's actually been quite clever. I think all the main parties have spotted that if you do this, once loan notes are paid off, once the business has bought itself through the trust for the benefit of the employees, these businesses will reinvest more, they will grow more, they will employ more people. So it's a great legacy, but also, as a consequence of that, they'll actually end up paying more tax, not less tax. So I think that 0% is quite clever. If they change entrepreneurs relief, then, and there's some talk about it going up to 30%, some even say 40%, then, or capital gains tax and the relief on it, then of course that 0% is up for threat. So we're going to be watching very closely what happens next March, and there's a real window of opportunity to do transactions now before the next budget cycle. Lock that tax break in. So employee ownership trust versus management buyouts is our main discussion here today. And what's in it for the employees? Well, the biggest advantage for managers of doing a management buyout is the whole, you hold the shareholder value. You've got the opportunity to grow the business and therefore hopefully pay off all the debt related to doing the transaction and then resell the business. That's a massive benefit for managers if they're prepared to take the risks of personally guaranteeing it and also putting some hurt money in. Having said that, because we think capital gains tax is on the up, entrepreneurs relief on the down, actually direct ownership may not be as appealing to some managers as historical. Also, there are increasingly people who are in the key management team, they're on their 70, 80K a year plus salary, can have quite a good life around that, who do not want to take the risk of being a full owner. And in that scenario, they're happy to run the business, but they don't want all that comes with being a full owner, which, if we're candid as entrepreneurs, for those of you listening, can be a bit full on. I think there's one thing COVID has reminded us, that being an entrepreneur is a constant marathon, and that's the same for management buyout. So the benefit for employees, employee ownership trust, but also managers, for managers, once the loan note's paid off, managers get paid in the upper quartile for the sector. And I think that's a real important benefit. So you're almost kind of, when you do this, and we have people who don't always go straight to their employees, they structure employee ownership trust, they think about values and get clearance before going to talk to the senior team. But when they do go and talk to them, they're nervous. But the sale is, look, once the structure's paid for, you are going to be the key controllers of this business, and therefore you're in a position to control salaries towards the upper quartile, subject to the trustees, of course, approving that. And maybe Sue can comment on that later. Beautiful benefit for employee ownership trust is that all employees can have up to 3,600 tax-free benefit. Now, actually, for senior managers, that's not that exciting, but for your guys in the warehouse, your 20Kers, your 25Kers, if you've got 50 people, you know, the average wage salary, this is the difference between a family holiday or not. And it's the difference, therefore, in retention for you as a business owner handing over that legacy. So, and the fact that they're co-owners is exciting. We don't like at Avondale, we're the only advisor in the UK that's doing legal, financial, trustee and strategy around employee ownership trust. I think it's really important when we talk about strategy that we look at what we're trying to achieve with the employees. An awful lot of people are coming at employee ownership trust purely around purposeful capitalism, whereas we're looking at it more as, no, you as entrepreneurs need to get your value. You need to make sure that you are securing that shareholder value. But also, in particular, what's the business model? How good is it? How sustainable is it? And the key work for us is more on the core management team. So you'll end up with three basic, if you like, panels. You'll have the trustee panel, which is largely administrative. You'll have the management board, and they're the guys that run the business and navigate the rivers of cash. And then you'll have whatever employee voice that might go on. And a lot of people are tackling employee ownership trust around, well, what's the employee decision-making process? How do we get them more involved? And we definitely agree with that. But certainly for smaller companies, you know, sub 50, sub 100, don't start there. Start in the center. What's the business model? What's your management team? How do they deal with the commercialities? Because, you know, employee ownership trust, if you get them right and structure them right, much better business model, but they still need to be competitive. And it's a highly competitive world out there. So absolutely staying ahead of the competition is center stage in this. They're not all about committees and employee voices and sort of cooperative capitalism. In terms of, I see we've got lots of questions from Nicholas Harden-Smith. Thanks for that, Nick. Please, others ask questions. We will get to them all at the end, Nick, but we've got one on costs and support here, which I think Nick has asked, so I'll cover that. Employee ownership trust deals are cheaper than management buyout deals. And that actually, certainly if you use us, remember I said we've got financial, legal, trustee and strategy in the offering. That is one set of advisory fees, and that includes the taxation clearance. Whereas if you do a management buyout, trade sale, private equity, typically you have a lawyer, you probably have an accountant, corporate financier, so you may well end up with three sets of fees. The other point is often and usually those fees are to the shareholders, whereas employee ownership trust can be to the company, so it's corporation tax deductible. So usually much cost lighter. The other benefit is that due diligence is lighter, so again less cost in the due diligence for doing a transaction. We're typically working on a charge structure which is for a feasibility study. We've just done one at 10 million. The feasibility study was 10 million. We charged 7.5 grand on getting clearance and then 2% on the transaction. But it depends what you've got, depends how much preparation you need. Management buyouts, we may have a very slightly different structure depending on what fundraise you need. And employee ownership trust, if you need third-party debt, then we'll probably load the commission a little bit more. So, and again, there's another great question from Nick, which I've said employee ownership trusts tend to be 30% on day one. We did an employee ownership transaction, Arbuckles, where we got 70% on day one because we went out and got third-party debt. So there's no difference there. We can do the same as you would with a management buyout and getting that third-party debt. But typically, the day one cash is, what are the distributable reserves? So the advice is, if you've got clients that are looking at this, or if you're looking at this, stop taking money out, build out the surplus cash. That's what we'll use for the initial payout, typically to do the deal. If you've got civil loans, can we take that offline because it's complicated? There's a debate about whether you can and can't use them for this structure. So if we can park that one and take that offline. So going down line by line, costs and support. There's lots of advisors available for management buyouts, trade sales, not that many for EOTs. We like to think we're a great house because we're doing the strategy as well as the deal. And I think that's equally as important actually for management buyouts. We talk about risk. And one of the things I've observed, I mean, I've been helping people buy and sell companies for 30 plus years, including reselling management buyouts. And one of the issues you find with management buyouts is the assumption that the managers, by proxy of having bought the deal, will change their mindset to that greater leadership or entrepreneur mindset. And for us, actually, we think that is potentially a challenge with management buyouts. You very often find that the managers manage the status quo. What they don't do is lead the business ahead of the market and change the business model. Now, I actually think that's tackleable with management buyouts. I'm not criticizing it. I just don't think that the support is given or the conversation is had with the managers about that. You've got to look at your risk profile. You've got to look at the way you make decisions. But the threat for me with management buyouts today is our stats are that the business model that you start today within 10 years will look utterly different, i.e. markets are moving more rapidly. So if you've got a management team that are good at managing status quo, but not good at leading the business model ahead, increasingly they will be overtaken. This is the whole, why did Netflix take over Blockbusters? Even though Blockbusters was in conversations to do an alliance with Netflix and walked away. Well, Netflix was a different business model, obviously in the end better than Blockbusters from a DVD point of view. And the managers didn't disrupt themselves. So of course you've got the same equation with EOTs and management buyouts, and that's why we're saying you've got to support these transactions with more strategy and more support and training the core team to make those changes and change their risk profile. Okay, future business, how are they perceived in the marketplace? Trade sales, of course, we know there's a real challenge that they're not always well perceived. Customers don't necessarily like them, can be disruptive. I think there's a viewpoint that many executives don't stay after transactions, and there's probably a lot of, we know there's a lot of studies around that. Something like 60–70% of execs leave within the first 2 years because it's a big cultural shock. And a big shift as synergies and economies of scale kick in. Often employees are in the firing line for those economies of scale as well. Whereas EOTs and MBOs, you tend to be able to retain the core team. Private equity deals, yes, you will retain the core team, but they are far more commercial than owner-managed businesses. So do expect high performance management appraisals, very much Excel driven and accountability. If you're no good at your job, you're out. That's good for the growth of the business. So if you're going to retain a stake with private equity, that's positive, but can for you as a retaining shareholder, but again, not necessarily for your core loyal team who may not make the grade under that ultra focused precision analytical Excel spreadsheet that private equity tend to employ when they're looking at companies. Management buyouts, employee ownership is much softer for the team in terms of change. And I think customers like them, and in particular, employee ownership trusts are very well favoured in tenders. If you're operating in public sector, again, incredibly well favoured, because this is seen as part of the solution to the social mobility issue. But we have a sort of private view on that. We think we're absolutely, by the way, get purposeful capitalism as advisors. We think it's exciting. But we think you can align you getting your value out of the business, purposeful capitalism in terms of creating a better business model, and making hugely competitive businesses if you get your management team right, because these businesses will reinvest more for the growth. Employee ownership businesses will invest more for the growth once the structure and loan notes are paid off. So that is hugely exciting for the economy and also for your legacy. Owners, advisors, entrepreneurs, we are all interested. I don't know why, because what COVID tells us one thing, life's short, but we are all interested in, well, what difference did I make? And is it all about money? We were talking to a chap yesterday who grown quite a successful business looking at employee ownership trusts. He said, I'm an ex-social worker. Yeah, I want to be wealthy enough not to have to worry, but I'm really not interested in, the massive headline numbers. I'm more interested in the difference I make. And that's certainly an attitude that's coming through in the younger generation as well. So I think we're going to see more employee ownership trusts around that area. There's something like 500 today in the UK. And we're very lucky today. Sue Lawrence, I'm going to be handing over shortly to Sue, just for 5 minutes to share some of her insights. But she's one of the key trustees in the UK, sitting on 15 of those boards. So this is a really exciting area. And I think if you look at the difference between MBO and employee ownership trusts, there's not as many as you think. And the tax breaks on longer periods make them more exciting, perhaps, than MBOs. And the reason there are so few is because it's relatively new and not that understood. And I think that's the truth of it. I don't think the advisory market has spent enough time truly thinking about what this business model is. And we talk about 2014 as when 0% came in on employee ownership trust. That's true, but the model's been around a lot longer. John Lewis, of course, being the most famous employee ownership trust in the UK. So I'm going to stop rabbiting on, and we're going to get Sue just to chat in a second. But I just want to do a little wrapping up for you on structure of employee ownership trust, and the questions are coming in as well, which is great. So we're really much more excited about hearing your views and questions as we go, rather than us just talking at you. But just to sort of come and sort of finish on valuation and due diligence with employee ownership trust, it's very important that we understand. Oh, hang on, have we lost the screen there? Oh, hang on, just bear with me. Zoom doing its stuff. Hold on, I will get it back if I can. So, Greg, do you want to turn your microphone on and talk whilst I deal with this technical issue?
Yeah, of course I can.
Because I can't do two things at the same time, and I don't know what's happened there.
Certainly not going to comment on that. So shall I?
It's a male ability. Let's move on. Right. Okay.
Oh, there we go.
Yes. So, welcome to the webinar, and thanks for joining today. I think it was 3 years ago, wasn't it, Sue, when we first said to you that we thought about being a trustee on EOTs, and you've taken it further than we have, which is exciting. We've done about 5 of these, but Sue's on 15 and has a team doing more. So, but it's growing, yeah. 250 to 500 in those 3 years in the UK. What do you see happening out there, and what's your view on them?
Yeah, it's really interesting. I think just generally on the market, I think the word is now out. People are starting to understand them a bit more and know about them. I think it was one of the best kept secrets in the M&A market for too long. So now more people know about it, more people are grabbing the opportunity. And I think particularly with sometimes trade sales aren't available, or it's not right for the business, then the EOT is a much better use of sort of an exit strategy. It also means that you keep the ethos of the business going, and as anybody on this call who's a founder of a business, they've nurtured their baby from being a baby into a teenager. And this is about transferring the business into being an adult, growing it, allowing it to run on its own without that sort of nurturing as a vendor. And I think people are seeing that as an opportunity, and particularly with succession planning, that sort of future. This is a soft succession planning. You can gradually exit your business by selling to your employees. You can actually leave on day one, but most people will gradually leave. We've spoken to a few people recently, founders who are leaving the business, but actually what they're doing is they're transferring to the employees through an employee ownership trust, but they're stepping back from the business. So the way they're stepping back is to continue to do the bit that they love, whether it's the client interaction, whether it's the part of the business that they originally fell in love with when they started the company. So they're often stepping back to do that and allowing a new management team to take all of those decisions, and the in-house the housekeeping of the business is being given to somebody else. So actually that they almost, in some cases, they almost fall back in love with the business because they've gone back to what they love. So I think that's really nice to see, and that really helps people gradually engage with their future and move towards potential retirement, but not with that sudden sharp drop. So I think it's a really soft exit. As you said, we work across a number of companies, from 15 employees to 800 employees, and across sectors as well. So this isn't sector specific. There are certain sectors that have embraced this more. And I think, again, that's just the word of mouth. You see a lot of architects' practices. One's transferred and then they share it with everybody else. And then there's lots of architects' practice. We have a number under our umbrella that we're trustee on. Construction firms, a lot of construction companies have transferred to employee ownership.
That's because the multiples on trade with constructions have never been great. So, with employee ownership trust, you can actually beat the trade deal. Remembering with loan notes, there's 4% interest as well. We did one with 5, but we pulled it back to 4.
Yeah.
So, again, from a value point of view, you can actually beat the trade deal that way over the duration. But so what? I'm going to. Sorry, Greg. I'll bring you in a minute. So you had a couple of slides. Are you bothered about sharing them? Because I'm having problems with my tech.
I've got them printed out in front of me. I can just talk through them.
And you can talk through them. Okay, that's cool. So do you want to do that, and then I can ask you some questions?
Yeah, that's fine. Yeah. So I think the one thing I would start off with, though, just because it's got employee in the title doesn't mean that the business is run by the employees. And I think, Kevin, you picked up on that really well. There still needs to be a management team. There still needs to be people making the decision and setting the direction of the business, because otherwise it just drifts. This is not management by committee. And I think what I've seen, certainly coming into this sector a couple of years ago, and I've run trust companies for the last 15 years, so the trustee bit for me is quite relevant, but I'm also a chartered director, so running businesses, that business decision for me is really important. What I find is a lot of people come into this and they overthink the employee bit. They think you transfer to employee ownership, and actually, let's be clear, it's not employee ownership. They don't own the shares, they're beneficiaries of the trust. When they leave the company, they lose that benefit. So they're only beneficiaries while they're employees. And they probably come into that after they pass their probation, or there's a legal limit. You can restrict their becoming a beneficiaries for up to 12 months from when they join the company, but that's the maximum. And most companies align it to their probation period. So if you've got a 6-month probation period, they'd probably say you can't join until 6 months later. But then, as I say, when they leave the company, they lose that benefit. But that's why having that trustee body is quite important. And I will pick you up on that thing. The trustee board isn't largely administrative. There is a bit more that trustees do.
I know. But I don't want to get people confused, Sue. I'm simplifying.
Yeah. No, again, everything's in threes in EOT, even the title. As you said, there's the operating board, there's the trustees, there's the employee forum, whatever that looks like. The trustee role is oversight of the board, but in particular in relation to 3 things. It's the current health of the business, the future direction of the business, and the board's effectiveness in delivering against those 2. And you've touched on it really well. Having that strong board, or creating and developing that under the EO model, is just as important as in any other business. Yeah. It's still the decision-making forum. It's still the one setting the strategy. It's still the one that's driving the business forward. So you need to make sure that you've got that in place either before you transition, or, as you said, you can build that up over time. And I think that's one of the key messages I'd always give people is, it doesn't matter if you decided 6 months ago or 6 years ago to transition. Your transition period straddles that legal transition.
And I think that's quite important, Sue, because one of the things that we've been doing, and Greg's working legally on one for me at the moment, and when we do the valuation modelling, we're not doing what the accountants have done, which is, well, let's look at the last 3 years and use that to justify to get the clearance. What we're doing is a post-COVID EBITDA analysis, including adjusting salaries for the senior management to reflect the additional responsibilities they're going to take on, whether that's director risk, but also work in terms of learning strategy and board management and navigating the rivers of cash. And we do recommend a training budget is put in, because I think, again, you can do a deal, but you and I have both been around the Employee Ownership Trust Association, and there's some employees going, well, nothing's changed. It feels like a tax structure, which, in some cases is what's happened. Yeah. And I think unless you put in investment after it, whether that's, with the right trustees or the right training to your management board, you're not going to create that change.
Yeah. And it's interesting, I've got a client at the moment, it's a training company, so we do lots of workshops on what employee ownership means to the employees, but they've built up a strong management team. And whilst we all talk about that tax benefit of getting a bonus as an employee, actually the other thing that you can use that as you've got a profit within the business, assuming that the business continues to generate a profit, paying off the vendor loan, whatever, what else are you going to do with that? You pay your bonus, everybody's getting a good salary, they're connected to the company, but you can also build up that training and that career path and all of that development, because people are a lot more engaged in the company. It's sort of that's what the profits can be used for as well. So participation by employees is quite important going forward, and that's what makes these companies more successful.
So we bring Greg in and then try and tackle some of these questions. Sue, are you happy that you've covered? Can you guys both see the questions as well? Greg, can you see the questions?
Can't, no.
You can't. Okay, so it's only me that can see the questions. Okay. Well, we have a question on. So I've mentioned loan notes as deferred payments is typically the way employee ownership trusts, or a key element to employee ownership trust payment. You've got distributable reserves. You might have debt, but also typically loan notes. Some sellers are looking to put protection in on those loan notes because they're nervous about the trust paying them. And we've seen that being put into trust deeds. On the ones we've worked on, we've looked at that very differently. What's your view around that, Greg? And
yeah, so one of the key principles of an employee ownership trust is that the founders do cede control. And we've talked about the day-to-day operations not changing, and that's absolutely right. We've talked about the level of employee participation and voice, which will differ for each business, and the size of the business. But essentially, the founders are ceding control. And with that, of course, there comes a bit of friction in relation to the hat they wear as sellers who are entitled to consideration on the sale of their shares, because whilst they, as directors of the trading company, have ultimate fiduciary duties to the employees, because their main duty is to the shareholders, and the shareholders are the EOT, which holds the shares on trust for the beneficiaries, who are the employees. They do need some protection to make sure that the operation of the business, which is creating the profits, does pay out their deferred consideration. And for these purposes, it is perfectly acceptable to include some veto rights in relation to the manner in which the company is operated in their capacity as sellers. And these include some of the more sort of commercial areas of the manner in which the business is operated. What they can't do is they can't include sort of something that gives back control to them whilst wearing the hats as sellers. And that's obvious, because it means they retain control, but also it causes a huge amount of friction in exercising their duties as directors. So these are sorts of things such as borrowing above a certain pre-agreed amount. They are maybe recruiting employees or giving salary rises above a pre-agreed amount. They are not the direction of the business. They are not agreeing the business plan. They are not sort of the absolute rights to control the direction of the business. They are the sort of commercial sort of protections that ensure that that there will be sufficient funds that the company can, and this is how it works, gift the profits to the trust for the purposes of the trust paying out their deferred consideration.
Yeah.
And we can include those in the share purchase agreement. We can include them in the loan note instrument. To me, it seems to make more sense to include them in the loan note instrument as matters that would accelerate their consideration if they weren't to if the company wasn't to ask for that consent on those veto rights, but it makes no odds. It's just setting out a reasonable set of short form protections for those sellers to make sure the company does deliver on paying up those gifts so that they can fund the deferred consideration.
Yeah, and the interest,
Would add as well. Sorry, I was going to add what we've seen quite frequently as well. In addition to those legal sort of requirements, we often see a letter of wishes from the vendors. So, and within that letter of wishes, it's things that they've learned or they've sort of encapsulated within the business as they've grown it. And it's almost that's the ethos document. That's the one that says we want to make sure that we still have a huge big training budget, or we're talking to one client at the moment who's got a charity committee. They want to continue the charity committee and all of that sort of stuff. So you can have that soft letter of wishes that would go to the trustees. The trustees obviously is independent, don't have to follow it, but at least it gives the company a feel for sort of that longevity of the ethos going forward. And we would encourage any sort of vendor who puts that in place to actually share that with all employees as well, because that's almost their definition of what their baby, the original ideas around their baby.
It's important. So I'd like to try and get some of the questions in from the delegates today. Again, reminder, we're recording this session will go up on the website, so if you want to share this, do share it. Also, if we can't get to your question today, all the panelists will be available. We'll send a sort of email contact so you can get hold of everybody. We're always happy to chew the fat. We're very passionate about this subject. And very expert on it. There are nuances. I do think a reminder for everybody that it can look complicated, but actually, if you do this right, it's a relatively simple exit strategy and one that you can control. And then we're back to, well, what's the strategy for the business? But let's just take some questions. So there's one from Graham Daniels here. If we have various level shareholders, could the largest shareholder put his into trust for the staff? Greg, do you want to take that one?
Absolutely. So long as the shareholders that are selling to the OT, if it's not going to be 100% sale, so it's going to be the largest shareholder, as long as that shareholding is a majority interest, not just number of shares, but also it's really important from a tax perspective that it's voting control, dividend control, the rights to pay out a majority of the capital and winding up of the company. So long as all those boxes are ticked, yes, the largest shareholder could sell to the OT, leaving the smaller shareholders holding their shares. It makes the structure more complicated than 100% sale, but it's absolutely possible so long as that controlling interest is transferred to the trustees.
But you have lost the 0% tax break on the future sale.
Yeah, it's a one-time only. So when you sell the majority interest, it's just on that occasion you get the 0% tax break, not only future sales of the remaining.
So our preference, if people want direct shareholding, is to sell the whole lot and then to re-earn the direct shareholdings through EIS or something like that. So it's quite clever. We do question whether direct ownership makes much sense with these. I mean, I'm aware of one coming up for potential resale, but there's not much evidence of these businesses being put up for resale. And that makes sense because they're going to be run for the benefit of the employees, and the value is held not just with a few key individuals, the value is held across, 50 or 60 individuals or 100 individuals. So, the incentive isn't quite the same for that deal to resell. Okay, so another question. Can an EOT sale be selected employees with differential share employee ownership? Again, I think it's you, Greg, isn't it, really?
Yeah, so if the question here is when the, So if you're asking here, I'm not quite sure what the question is, but if the question here is if people own different sort of classes of shares, yes, as long as there's a controlling interest being transferred across. If the question's about an EOT having the majority shares with other employees holding a different number of shares each, as I said, that's absolutely acceptable. But the sale isn't to selected employees. The EOT sale is to the Employment Ownership Trust. It's to the trustees. So, you know, whilst you can have retained shares by individual shareholders who are employees, and whilst you can have EMI options still in play, so long as they're not crystallized by the sale to the EOT, you can have those remaining. And in fact, you can, if you're not doing a complete sale, you can have EMI shares, share options issued to senior employees to incentivize them not just to benefit as employees from the trustee relationship, but also to benefit themselves if there was a later onward sale to trade or private equity. So yes.
I mean, that's good. I'm sorry, you corrected me, Greg. I said EIS, it's EMI, so you're absolutely correct on that. Sorry. So too many acronyms, EOTs, EMIs, and EISs. My humble brain can't stay up with it. So Sue, I think this is a really important question from Anonymous, because this is management buyout versus EOT. That's the gig we've got today. So how have management perceived an EOT? Do they regret not having had the chance to do an MBO? Are they better locked in or not? So it's the pro and con for managers, really.
Yeah. Let me answer the other question first. If I can just add to what Greg just said on that distribution, so the distribution of the profits from the trust has to be equal across all employees.
Yeah.
So there is no differentiation. You can only differentiate by length of service, salary, or number of hours worked. That's it. And it's got to be consistent across everything. So once you're distributing from the trust to the employees, that has to be consistent across the company.
Yeah.
And picking up on that point around sort of how's it perceived, particularly against an MBO, I think often, I mean, the companies I've spoken to where maybe there has been an MBO considered for previous years and then they've moved into an EOT, a lot of it is around actually the management team saying, I don't want the stress, I don't have the financial, as you said, Kevin, earlier, don't have the financial resources to do that. And actually to get the financial resources, we'll need to take on more debt for the company, for the individuals, and sort of maybe don't have the drive that the original founder had. Yes, and it's very different being a manager to an owner. So.
I'll make a joke about that, so, you know, because obviously, you know, we worked really hard to get the big house with the electric gates, but then the electric gates always break down, whereas in fact, you know, a 3-bed semi, and just any holiday at all is fine. So I think some senior managers have worked out, you know, the whole going up the cycle and then figuring out how to go down it. Why bother? You know, if you can have a pretty good life, do your hours, and that's where the EOT kicks in. We've got one at the moment where we're figuring out how to increase the share value of a minority share value. Because they had wanted to do a management buyout, so there are ways that you can structure things to compensate for that. But once they got their head around what they were getting as a minority, and do you remember, so we had that print business where the same again, the guy had only recently bought his 15%, but when he realised how much cash he was going to get at 0% tax and the profit he'd made on it, he was utterly delighted. So
yeah, and also it's the complication going forward. If you've got a hybrid model with multiple shareholders, if the trust's a majority, but you've got other shareholders, how do you actually distribute those profits? As you said, you've missed the chance of the capital gains tax, and now you're fighting with your own employees about the distributable profits. It makes it quite messy and quite awkward, and to say you've lost that opportunity at the outset.
I'm pretty clear and keen on the 100% deal. Yeah. And actually, I think we sort of answered Russ's question here about profit distribution, but of course I want to make the point. Profit distribution, there might be a small bonus, and we would load that into a model from day one, but invariably for the period of the loan note, you know, whether it's 5 or 7 years, there probably won't be that much profit. It's got to go into paying that loan note. So it's only after that period that you get that, oh, well, what are we going to do with the profit distribution and all the reinvestment?
I would add, though, just to sorry, to just jump in on that. What we do see a lot of the time is if companies are already giving, say, Christmas bonuses normally,
Yes.
that Christmas bonus can become part of the trust distribution. So at least they're getting the tax-free element. So you can continue with that, and that is the benefit.
Yeah, now, this is grey, by the way, on bonus. I do want to say this is grey because we've got two at the moment where they've been paying bonuses which are more performance related, almost like a commission, and you cannot do a flip to the EOT trustee for that. So the government, quite understandably, don't want to lose the the tax on bonuses which are perceived as salary. So then you get into, well, what's discretionary and what's not. But again, that's why you do your due diligence when you do these things. So you get all those things right. But I think the point about excess profit is once the loan note's paid off, there'll be plenty of excess profit because you haven't got shareholders taking the money out. That is reinvested for the benefit of the employees, which is a real positive for them. But it is also why we're recommending, 5 to 7 years. I think, some people have suggested why not do it over 10. And the challenge with that is, your managers are going to be so old by the time they get to see the benefit after the loan note's paid, and so you've got to do it over a period. Also, to answer one of the other questions, which is Peter's here, can the repayment terms be flexible? The loan notes are a promise to pay. So another reason for sort of suggesting the 5 to 7 year period is many businesses have a good year, bad year scenario. Well, what we tend to find is 4 good years, 1 bad year. It seems to be 1 in every 5 for many. I think the benefit of employee ownership trusts is because the loan note is a schedule and a promise to pay, what you can do is if you have those bad years, you can kick the period out. So if you do 10 years and then you've got to kick the period out, the people you're employing will be retired by the time they see the benefit of it. So if you do 5, 6 years and then kick the period out, so the loan note's expended by a year, another 4% interest on that year for you as the sellers, so not a problem. Great, in a way, it's good to get yield. And as far as the managers are concerned, it's it's not the longest cycle ever. Okay.
Kevin, can I dip in with one of these questions? Sorry,
yeah,
it's
go
for
on.
Greg, but I'm going to sort of start the answer and maybe Greg can pick up afterwards. Somebody's asked, what does the legal structure of an EOT typically look like? A couple of our clients have converted from being an LLP into a limited company, which you need to be a limited company to transfer, and then you put in the EOT. The benefit they've had of transferring to the limited company is that they then had some R&D tax credits that they can claim, which you can't do as an LLP. So actually their financial benefit increased as part of that legal structuring in the first place. So that gave even more sort of spare cash almost to pay off that vendor loan. But Greg, I didn't know if you wanted to pick up on that.
Yeah, no, absolutely. Yeah, actually, that's quite right. With the LLP conversion, that needs to be done first. It's not just it needs to be a company, but also needs to be a trading company. But in relation to the legal structure of the EOT itself, the way it looks typically when you're dealing with a corporate trustee is that the operating trading company sets up a subsidiary, and that acts as the EOT trustee company. And when we're talking about the trustees here, we're talking about the independent trustee and the founder trustee or the employee trustee. Those are just essentially trustee directors of that trustee company. Then it's rather circular because that subsidiary company that's set up by the trading company, that's the trustee company, then buys the shares of its own parent. But of course, it's only buying the legal entitlement to those shares. The actual benefit of those shares are, as we've been discussing all morning, held for the benefit of the employees. And just to square that off, there's a specific carve out from the Companies Act that allows a trust of this nature to hold the shares in its own parent. So that's how the structure looks. And as we say, that there may be other shareholders or EMI option holders if it's not 100% sale in the trading company. And there may or may not be, and I think as Kevin's alluded to this morning, there's no reason there's not always a reason, and there's certainly no mandatory requirement for an employee council to feed into that management company, the operating company. So
Right.
that's how it's a circular structure.
To pick on that, we have had a good question from Brian. We have a group of companies. Is it best to do the EOT at group or subordinate level? Now, we've just done one, haven't we? The 10 million one where this question came up as well. So let's share our knowledge on that, as you're talking about structure. So if you've got subsidiaries, what do you do?
Yeah, so if it's the whole group that's going into the employment ownership trust, then yes, it would be the holding company, and then the EOT would hold the shares, the majority of the shares, the controlling interest in the shares, if not 100%, in the group holding company, and that company itself would then hold the group subsidiaries. If that's not the case, and the EOT is being the trading entity is a subsidiary of the holding company, then it would be the subsidiary that's sold to the EOT. But if the whole lock, stock and barrel is going into the trust, then it's the shares in the holding company.
But in that one, in our view, the subsidiary structure was complicated for the business,
and we wanted to flatten it.
And then we come back to what's right for the management team, and we actually recommended a hive up, or sort of a roll up of the subsidiary, because you end up with lots and lots of different layers of companies. The reporting does get more complicated.
Yeah, if it makes sense for flattening the structure, then that's absolutely right. There may be good reasons for spreading the risk by having different subsidiaries, perhaps holding IP, and then the trading arm of the subsidiary. But yes, if it makes more sense, and the complicated structure has been put in place prior to the OT, then flattening the structure can be a good idea.
But we just to add to that, we have got a couple of clients who've got international businesses as well.
Yeah.
And we've seen different models for that. One has brought the international business as part of the EOT as well, so that all of the employees, wherever they are, also get the benefit. Obviously, they don't get the tax benefit because it's not in their country. Another structure we've seen is where they've actually hived off the international business into a separate legal entity. So the EOT is only for the UK business, and they've separated it geographically rather than anything else.
So get their norm. So I'm mindful of time, guys, and let's say we are recording this webinar. We will put up in a minute a reminder of some other webinars we've got coming up, but we'll also be sending out our contact details. You can look at our various websites to find us if you've got more questions. But there's one here from Nick, which I think he asked earlier, Sue. Now he's asked it twice. I've got to go through it, but it is also relevant, which is what are trust costs and how are the trustees selected? So remember, you've got your management board, you've got the trustee board, and then you may have an employee council debate. How is that trustee panel selected? How do you appoint them? What does it cost to run?
Yeah. So the trustee panel is different for every company. Sometimes it's a mix of employees, independent, and the board. Sometimes it's just a vendor, the independents, and no employees. We always encourage people to get an employee trustee at least during the transition period, maybe after 6-9 months or whatever, to get that engagement. The trustee are selected. Normally, you would want somebody who's got EO experience, who can actually add value to that structure and actually can help you through that transition period. And then you have a successor trustee later. So somebody with that understanding of the broader picture, not just the financials, not just the employee bit, all of it and how that connects together. And most importantly, what the trustees are not responsible for. I think that's the other thing that you often do get. You often get people who will appoint their accountants to be their independent trustee. And then they realise quite quickly that they're conflicted. And I've got a number of examples where actually the accountants become heavily conflicted because there's been an issue with the account. So you're better off getting somebody totally independent. And then it tends to be charged on a per meeting basis. We suggest quarterly meetings because it's a good time for the board to have that oversight and that sort of positive and encouraging discussion about the future of the business and where it's going. So you're basically playing for a quarterly meeting and maybe ad hoc calls and meetings internally. So it tends to be a day rate and a project rate depending on what you're doing.
And I mean that day rate, Sue, and I know it's commercials, but I know on one you've run at £1,000 a day previously.
Yeah, we see them traditionally between 1,000 and 1,500, depending on the complexity of the company.
And it's corporation tax deductible again, so it's not expensive. For that, and particularly, I've got to do. I mean, we tie with Sue, so if you're using us for this, then you'll get the first year with Sue in most of our fee structures. Some of the smaller ones we can't do that with, but with most of them we can. And that's because we're so passionate that getting people that have done this before just cuts out all of distraction of having to explain it to people and getting their heads around it and what have you. It's quite fun with Sue as well. She did one where the ex-seller insisted on being on the trustee, and then 6 months later went, well, this is a waste of time, and then quit. So So he wanted to be a trustee because he thought he'd have more protection on loan notes and realised it may not apply and split the difference. So that's good. So guys, I'm sorry if we haven't got through all your questions. We're now that hour in. And I mean, because this is such an exciting business model and does compare very favourably to the management buyout, you know, hopefully some of our passion for it has come across for you today. But you know, we are leading experts in it, so all of us are available if you've got more questions. We will try and send out. It'll take us a week or so, an Excel sort of Q&A response. So if your question hasn't been directly answered, we will get that out to you in a Q&A response. We'll also be sending out, remember my 4 columns of the pros and cons of each type of deal structure, that will be available as a PDF as a follow-up. I hope you've enjoyed today, and we'd love to hear your feedback. We've got a few more webinars coming up, so I shall just finish off, but I will bring that slide up just so that you can see what those dates are and when they're coming up, if that's okay. There we go. Oh, hang on. There we go. So that should be the date. So thank you for joining us, and we'll catch up soon.